Good afternoon, everyone. This is Brad Matheny. I'm coming to you with a quick little update. If you don't know what I do, please come take a look at ment.com. This is my website real quick. Drag this over so you can see. I am a researcher and analyst. I develop tools for traders. I run algos to help traders understand how to find better opportunities. And I do a lot of extensive research every week for my subscribers to take advantage of the market trends. And right now I have an urgent update for you that I need you to take care of. Please just take a minute, come over here, check out what I do. Right now I've got this great Christmas deal that's going to expire the end of this coming week. So by take a look here real quick, the 18th or 19th, I will be taking it down. So if you want to give yourself the best opportunity to try to profit from the markets in 2025, come over and check this out. And I'm going to show you some of the depth of my research. So right now, I think it's very important for you to understand a couple of things. Number one, take a look at this chart. Well, yeah, let's start here. Because number one, this is a custom index that I created to try to help traders understand what's going on in the markets. This is the Fed Fund Rate Easy Money Index. This is proprietary. Anything typically above this blue line here is relatively easy money. Anything below this blue line is relatively tight monetary policy. Okay, meaning that the markets are, it's tough on consumers, it's tougher to get a house, credit interest rates are higher, and monetary policy is aggressively tightening or some moderately aggressively tightening money. We have seen a big move, and I don't want to scare you, but you might want to sit down. We have seen a big move in this aggressive policy. The feds are likely paying attention to this very aggressively. It's only happened since basically Christmas, right before Christmas. A lot of people are not paying attention to this because we've had this big volatility between Christmas and the New Year, and it's mostly driven by this move. And I need to explain to you how this move really plays out. This downward cycle trend in Fed monetary policy is indicating that money is tightening in the system aggressively, quickly. The Fed will likely have to make emergency rate cuts, is what I'm trying to say, and or address this monetary policy tightening issue, what's happening on the global debt markets, in another form. Global central banks are likely dealing with this as well. Now, take this into consideration. We're currently at 418 with this extreme, let's call it monetary crisis, is basically what it is. And what it means is that the Fed has been aggressively keeping rates too high, turned into a predatory Fed type of a mode. So now let's come all the way back and take a look at this chart. This chart shows us the data going back to 2008, 9, 10. That's the global financial crisis. And what you can see here, guys, is during the global financial crisis, when essentially the world's banks collapsed, we had a rally up into this 2.2, 2.3 area. We had the same type of monetary collapse here down to this purple level, indicating that monetary policy became very, very egregious towards the consumer, towards lenders, and it became very difficult for the consumer to operate, okay? The Fed aggressively cut rates down to near zero during this time frame, and it took literally until 2008, 9, 10, and the way you can see this is that we start to move out of this cycle phase into trending here and into real growth mode here. We didn't really get into, proper growth, real easy policy in 2014, 15, 16. This is when everybody started to feel more comfortable. Now, we have below that level right here, 2022, it looks like. Let's take a look at COVID, 2021, yeah, 2022, when we started getting below that easy monetary policy. And you can see here, during COVID, we were really in that fairly easy monetary policy all along. We probably would have survived COVID without too much intervention, as long as the government kept our businesses and our consumers operating, working, spending. But what's more important here is, you see where we're at up here, 4.18. Guys, we've never been there. This is kind of an extreme crisis level, and we're getting down into that lower range, and where it's putting a lot of stress on the consumer. We need basically to see the Fed lower rates, or inflation to come down considerably, or something's likely to break in the banking system or the hard asset valuations. It's getting to a point where aggressively, this is a big move. This is a very strong move. We're weakening very aggressively to the downside, and we are already well below that comfortable, easy monetary policy. So again, come back over here, take a look. Come back here. You see how we've broken down into that lower channel? So look, I think I've actually got another chart here. Hold on. Yeah, this one. You see how we've broken down into this lower channel right here? So we're moving very cleanly to the lowest level we've been in since 2010, 2011. Actually, we kind of danced around these lows, which is the same low back over here, 2018, where the Fed had the same problem. Okay, the only difference is that we had a more moderate increase up to the 1.0 level. Okay, we're up at 418. This is pretty extreme, guys. Even the global crisis, the global financial crisis, was right up in this 210, 220 area. We're at a pretty extreme level here. And we could see the SPY break downward unless the Fed makes some sort of a move, which is why I'm telling you, you need to be very aware of the risks that are at play right now. You need to pay attention to the news. We're transitioning into the new president, President Trump. We've got the global debt market indicating that they're unhappy, extremely unhappy about what's going on right now. And there's probably a 60 or 70% chance that we're going to see some sort of a breakdown in the market over the next 4, 5, 6 months. I don't think it's going to be excessive, because I think the Fed is going to react to try to stave off this type of a move, this type of crisis event. But again, what I'm trying to tell you is, unless we get this weakening, meaning unless we see this come back down into this 1.0 or below 2.0 level, we are going to be looking at extreme pricing pressure put on the markets by the global debt market, meaning global debt investors are going to price in risk factors that are going to continue to keep yields much higher. So understand that, you know, the only way to settle this market is to move back into more comfortable territory for global investors. Given the fact that yields have elevated so much, I really think probably a 2, 2.5, 2.25, maybe 2 3/4 rate would be the most logical area for us to move this down. And then we'd have to tighten our belts and make some changes. But again, this is likely going to prompt a Fed decreasing rate simply because we're getting this excess type pattern. And again, take a look at how extreme this is. Again, here's the 2008 crisis. You can see we're moving into relatively easy monetary policy. So here we have this kind of a weakening trend here. No big deal. Everything is good. We're getting into easy money policy through here. That's what this tells us. Easy money policy. Everything is pretty good. No problem. It was only until we started getting this big breakdown in the SPY when the bank started to fail. And they really didn't start to fail till back over here. So understand this with the early warning signs. Easy money, easy money. Fed, look at what the Fed's doing. They're decreasing rates. They knew they had things too high. Housing markets started to crumble. Banks started to have some issues. They tried to lower rates. It went super easy and accelerated again. Okay, then what happened? We started getting Bear Stearns collapse. We started getting global collapse in the markets, and we got this pricing fear index on the global debt market. Okay, that didn't settle until the low here, but that was the low in the stock market. It was also the peak of the destruction of the credit market. Okay, we then started to move out of this zone, and in my opinion, really started to base right over here, 2010, where we started to see this acceleration back to the upside. Currently, we're in this type of a downtrend. We're moving aggressively down into these lower levels, and we have yet to see the Fed make a move. So pay attention to this rally, pay attention to the SPY collapsing, and pay attention to the fact that, you know, we're moving into this downward cycle, and the Fed is not really aggressively making a move to the downside. So come back over here, and you can see that we are starting to see the Fed try to make a move to the downside, not very aggressively. You can see that we're moving down fairly aggressively into this collapsing market, and we're at the highest level we've seen in 2 decades. You know, really, it's pretty scary when you think about the fact that the markets, unless, you know, the Fed makes an immediate move or the government makes an immediate move to try to address this issue, we could be looking at something breaking within the next 60 plus days, sending the stock market considerably downward. So be aware. I'm not telling you that it is going to go downward. I'm telling you that the signs are there. And what you need to do, you need to come back over here and you need to pay attention to my research. So my research is going to tell you, if I take a look at this, that we are already breaking below this low, which is our ultimate low, our recent unique low. We have this signature low down here, which is a standout low. We also have this deeper low way down here. We have currently broken below this low. We're very likely to continue a downward trend here. So pay attention here. This is a breakdown low. We're very likely to try to continue a downward trend, but I will warn you that there's a very clean chance that we're going to get a rejection level here. The reason being is I think the Fed is going to go actively pursue this risk issue, and I think we're going to see some sort of a rejection area, just like we saw here. So understand that the market comes down, tests lows, and rejects very often. There's rejection here. There was rejection here. Now we've had a big breakdown on Friday. I believe we reject back up on the following week, heading into the election. But again, if this pressure does not subside, we are going to be looking at a bigger, broader downtrend, likely setting up into a consolidated channel, kind of like this, possibly carrying into 2025 in a fairly broad ranging type of rotation before basing and rolling out, which I think will coincide with the Fed easing rates and the government getting control of a lot of this uncontrolled spending. So we do have to watch these levels. And again, my research is really detailed. I don't know how to explain it to you any other way. The data you see over here, all of these, let me get out of this. And all of these charts down here, these cycle charts, these predictive modeling systems, the TT scanner data, the QQQ index, the base trend index, the smart money index, the market ratio index, the gold cycle valuation index. I do gold and silver as well. Real estate, innovation, leading index chart, fear index, cash flow index, volatility index, valuation index, and U.S. stock market index, amongst others, including my rotational modeling system, which has outperformed the market consistently by at least 11% a month. I want you to understand that, we're looking at a pretty broad rolling type of a head and shoulders formation. So ultimately, until I'm proven wrong, we're looking at that type of formation. Let me change the pen color so you can see it kind of like this, an inverted head and shoulders. So we're looking at, persistent consolidation maybe for the next 3, 4, 5 months before we roll to the upside. I need you to be aware of that. Minor potential crisis event. I think it's going to be very healthy for the markets to settle and unwind a lot of this debt, but it could cause, it could cause hard assets like real estate to drop 25, 35% or more. And that's a, potentially scary thing if you're heavily invested in real estate. So again, wanted to give you a heads up, but really wanted to tell you that, if you want some help, if you want some guidance, if you want to, have a chance at trying to take advantage of some of these big moves and follow some of my research, please come over and check this Christmas deal out before it goes away. Really, it's 6 months initial trial for $99.99, a heck of a deal. $18 a month for 6 months, basically. And again, I want you to learn what I do, learn how it works, and learn how to target the best trades you can and stay ahead of these big market trends. That's why I'm giving you this little special update, is because you need to be aware. The markets are pretty fragile right now. And, there's a lot of people out there telling you to get into this or get into that, or you don't know what you're going to miss. The reality of the situation is, guys, I told everybody back over here, get rid of that. I told everybody back over here in October 28th to get to 80 to 85% cash, and we are still waiting for these buy zones to set up potentially to get us into some sort of a buy mode. So we have been protected against risk since back over in this area. And again, the whole idea is trade efficiently. Don't trade like you're gambling. Trade efficiently, learn how to profit from the markets, learn how to take advantage of opportunities when they exist. Don't gamble away your life savings. Okay, hope this helps. Let's make this a great year, because I promise you, 2025, 2026, and 2027, 28, 29 are all going to be banner years. I mean, I'm telling you, the markets are going to go up bigger than you've ever seen, but this first 3, 4, 5 months of 2025 are going to be rough. All right, talk to you later.